This part is called What is Price Action? Since we already learned on how to understand the charts and what candlesticks are, we're going to learn on what price does relative to those based on time frames and different chart types. Price action is any representation of price movement, and that applies to any financial instrument, as in like stocks, futures, bonds. It really does not matter, and it applies to any type of chart, whether that be a bar chart, which is what we show, like a candlestick chart or bar chart, as in like the volume, a point and figure chart, which is something like this, where it would show up. It wouldn't show any type of wicks or bodies. It mostly just shows range. It gives you a better understanding of structure. Volume chart, which is what the chart that we would see at the bottom, or sometimes you would see a volume chart on the side. We can get more into that later. A range chart. It's almost like a bar chart. But it doesn't have any of the body. It just takes the high and the low of that candle. Or a Renko chart, which just takes the overall movement. It could also be on any type of time frame, whether that be a 1 minute chart, a 5 minute, a daily, a monthly. Price changes with each tick, which are pretty much any type of trades or orders going into the market. So any movement on any one of those charts or changes in price becomes an example of price action. When you're looking at charts, some movements may look very minor at first, like it's just really small, really scalpy or whatever. But you should not dismiss any of these movements. Everything that happens is happening because a group of institutions are making it happen. Our job is to follow what the institutions are doing. If they are because if they are able to move the market, then you have to assume that something significant is happening with every tick up or down. Sometimes things look very unimportant, but they can lead to very great trades. I believe that price action is driven by math and probability. It reflects the combined decisions of buyers and sellers, and over time, those decisions create patterns that repeat. When you look at charts from over 100 years ago, the movements look very similar, not because of coincidence, but because markets follow certain statistical tendencies. Price often continues moving in the same direction for a while, holding strong trends. Sometimes they snap back to the mean after moving too far, and tend to get more active during certain periods based on external factors. These behaviors repeat because markets are built on supply and demand. As long as the buyers and sellers interact the same way, these patterns will likely continue for another 100 years. If you look at these charts, are you able to guess which is an old chart and which is the present? Both are from the same index, the DJI, the Dow Jones, and both are on a weekly time frame. Both are from two different time periods. Are you able to tell which one is an old chart and which one is from the present? It was actually a trick question. They're both old charts from the Roaring Twenties and World War II. For reference, here's a chart from today. You would assume these were the charts from today because you would assume that these charts were the charts from today because the patterns look exactly the same to today's time frame. This is 2025 and 2023. It follows the exact same patterns as it has been from over those 100 years ago. If you're still not convinced, here are some very similar charts with crashes, because crashes are common. In 1987, if you look at the daily candlestick chart of General Electric during that time, you'll see a big bear spike followed by a triangle trend, and it looks very similar to the 5 minute chart of Costco, showing a big bear spike with then some kind of pullback. And it's also very similar to a 1 minute chart of E-mini, You see this every day. The E-mini, which is the Nasdaq futures, it crashes every day on small enough time frames. There's nothing special about a crash in terms of price action. They're all the same on all time frames. When you start out as a trader, you look for information. You search the internet, look on Reddit, watch videos, maybe buy and read books. It's easy to be stuck in how much information there is about candlestick patterns. The message is perceived to be obvious to someone starting out. Candlestick patterns can make you rich, and that they are the key to success. However, do you believe that Goldman Sachs, high frequency trading firms, and hedge funds make fortunes every single day using candlestick patterns to do so? I don't think that's the case. High frequency trading firms, for the most part, use tick charts, so a lot of times they don't even see candles. Most hedge funds use a combination of technical and fundamental analysis. Goldman Sachs has both fundamental and technical traders. I doubt they're paying much attention to candlestick patterns. If the big players on Wall Street are making a fortune and they're not even using candlestick patterns, I don't think candlestick patterns should be the cornerstone of your trading success. A lot of the time, candlestick patterns are just the byproduct of a trend with the support and resistance. If you watch CNBC options actions or fast money or any profitable day traders stream, you'll see them talk about the reasoning for their trades. They constantly talk about the trend, about channels. They say things like it's near the bottom of the channel, this is a good place to buy, or this is a bull trend and it's pulling back to that old high, which is now support, so they're gonna buy there. And it broke out, and now it's pulling back to its higher low. I'm going to buy or sell. You don't hear them say they sold a bull trend because there's a dark cloud cover pattern, a shooting star pattern, or a Rami pattern. All of these are just meant to sound really cool, but no, that's not what they're doing. It doesn't really mean anything. For example, consider a candlestick top in a bull trend. Can you make money from it? Yeah, you can. But you don't sell it. You wait a few bars, figure out where the bears will exit with their losses, and you place a buy stop to get long where they are getting stopped out. That's how you make money from using a candlestick top. You bet that it will fail because most tops fail in a bull trend, and you get long where shorts are taking losses. Like, let's use Apple on its daily chart to show a bearish engulfing pattern. So here's an example from 2012 where Apple's price before the split was $680, where there was a strong bear candle with a classic candlestick topping pattern. Should you sell the close of the bar or sell below its low? Well, on that day, using historical articles, uh, traders on Fast Money were saying that Apple has sold off more than $20. This was a $20 loss in a single day, and the few times it sold off $20, it rallied. So they were going to buy. And if you see on the next candle, it did go down, and they were right. On the close of that candle, they were buying. So traders on Fast Money were buying near the 21 moving average. I mean, they probably didn't use the 21 moving average, but since it was a strong bull trend, the market had not touched the moving average in like 20 or 30 bars. Even if it was forming a trading range, it was near the bottom anyways. So instead of seeing a great reversal pattern and saying, "Wow, I should enter a short because I saw this candlestick pattern called a bearish breakaway," where you have two consecutive buy candles and then a large red one. Experienced traders saw a bull trend and know most reversal patterns fail and become bull flags. It was far better to look to buy than to sell, and then what followed afterwards was a very strong rally. Almost one, two, three, four gap ups, almost an entire week of gap ups. And the traders that bought the pullback when it was down $20 did very good. If you're still not convinced enough and you think that was too far back, that was 2012, markets are different now, here's a more recent time where similarly in 2019, Apple had almost the exact same setup as it did back then. The same bull run where it didn't touch the 21 EMA in like 20 or 30 candles, and it was the same percentage down as it was back then. So we could follow the same strategy and wait for price to hit the 21 again, or just buy this because it's on the same part down and it went up again. And you can see that price dropped all the way down onto the 21 and very quickly scalped all the way back up, which then led to more gap ups and an even higher run up again. The reason why it does these things because EMAs in short are tracking areas of possible imbalances. They're taking the average close of all of these candles and trying to find the imbalances where price can lead to a strong reversal or a strong continuation. Like as in here, since it was in a bull trend, it came back down to here. There's a very high chance of a strong continuation of this bull trend. Going back to the slides, the market has inertia. It tends to continue what it's already has been doing. As in, if it's in a downtrend, it's likely to continue down, and vice versa for an uptrend. If it's in an uptrend, it's likely to continue up. One thing I like to live by is if you want to know what the bars will likely do to the right, you look to the left. Because history tends to repeat itself, or at least rhyme, and sometimes price will target previous highs and previous lows. In a bull trend, about 80% of tops will fail and become bull flags. In a bear trend, about 80% of bottoms will fail and become bear flags. In a trading range, where price has just been consolidating, about 80% of breakout attempts, up or down, will fail. There is much more to a top or bottom than a candlestick pattern. In fact, candlestick patterns are not necessary at all to make money, in my opinion. And my guess is that the best traders on Wall Street don't pay any attention to them. Trading is difficult, there is no doubt about it. The concepts are very simple, which makes trading look easy, but don't get deceived by this. Understanding is one thing, implementing is the hard and important part. Every trader quickly learns on how easy it is to lose money. Everyone does. Anyone who says they don't lose money and they have a 100% win rate is lying. It does not exist. Every single trader in the beginning would read, study, watch videos, take courses, get mentorships, and some would even attend conferences. They would try really, really hard, yet no matter how hard they try, they will still lose money. This is a normal part of trading. It's about knowing when to switch up the strategy or take a break from it. It does not matter how much they know about candlestick patterns, because candlestick patterns are not all that helpful. After losing enough money, traders can sometimes become desperate and start believing in almost anything. Many people take advantage of that desperateness, and they will try to sell candlestick patterns, and that they are the road to financial success. But there's so much more to trading than that, and candlestick patterns are one of the least important aspects of trading. Okay, enough about candlestick patterns. How can you use price action? Professional traders talk a lot about support and resistance and how they work with trends and channels with higher highs, lower lows, recent highs, and recent lows. They could also talk about the buying and selling pressure of a stock, or the risk to reward, and the probability of it hitting. Like when price is in a downtrend, and how it's made lower highs and lower lows, you can assume that next time price comes back up to this lower low, you can then sell it. Or how when price is in a uptrend where it's making higher highs and higher lows, you can assume next time it would hit the previous high, you can then buy. And it's the same thing that works for in a channel. When price is moving sideways, and then every time it would hit the top part of its channel, you could sell, and anytime it would hit the bottom part of the channel, you would buy. Or also say if price is holding a strong upward trend, anytime price would come up and is continually making higher highs and higher lows, next time it would hit this trend, you could then buy it, and most of the time it would work out. We saw that with Apple, where its trend was using the 21 EMA. And it's the same thing in a downward trend. When price is coming down, and it hits it is making lower highs and lower lows, next time it would hit the trend, it would be a good idea to sell. They may also say that the probability is small, so it's very unlikely of this play working out, but the risk is also small, but the reward is so large that the trade makes mathematical sense. Option traders can often think this way with essentially breakouts. It's it's an 80% chance that the top will fail, but if you have a tighter stop loss, which I can get on about that later, that if it does break that trend, price will move very quickly, very high up. They also focus on trade management, or risk management as it's also called, where you should decide on whether to trail your stops, like having a 5 to 10% drop on wherever the price is, so that you can let your winners keep on running. As it keeps on rising, you just you raise your stop loss with it, so as soon as it starts coming down, you would then sell it. Or scaling into trades by averaging up or down. So say if you're in a bull trend and then it just drops, say, like 10%, but it's still well within trend, you could then average down by buying more. Or say that when price is now moving sharply on good news, you can now average up because now the trade is even more certain than it was before, and you can now put more money in to gain more from it. So that they say to this most of the time that they bought it and it fell, so then they're just going to buy more because it's still well within its trend. This is not because of another candlestick pattern. It's because of the trend is up and the market is at a support. The trend resumes 80% of the time. So here's an example. Here we have Nvidia from pretty much August of 2025 till now. You can see that there is a lot of chop on it. So what we can do is to go into a higher time frame, on the weekly time frame, to get a better idea. And if we remove some of these EMAs just to get a clearer picture, we can see that in August it started peaking out. If you bring out the trend tool up here and then hold control just above the wick so it snaps onto it, and then when you hold shift while bringing it makes it completely flat. we can see this gets stopped out, or price moves through this many times, so it's not that great. So then we could go to another one, where say over here, 91, and then go across. We can see that price tends to respect this line a bit more. So we have the first part of our range, and then we could go again back to here, where over on this part, and then when we draw the range, we can see price also respects it a bit more. Whenever you see, also little tip here, whenever you see price come down and then open below any of its upward trend, downward trend trading, its trading range, it just opens below it. It never actually crossed it, and price would naturally want to fill that gap, which you can see it does very quickly. It's only when you have proper breaks up and down where that's when a trend is broken. But you can see that in Nvidia always seemed to pump up, at least since July of 2025, from $171, while at the top part it seemed to normally scalp all the way down at $190. This is on the 1 week, so if we go to the daily, we can see this act out a bit more clear on how there's always some top wicks. Sometimes price goes a bit higher, like opens a bit higher, but most of the time it is just going to come all the way back down. So it's a pretty safe bet to either sell at the top or buy at the bottom. So when people talk about setups, they're often talking about a setup that has two parts, the signal and the context. The context includes everything to the left. So what was its overall trend? Is it bearish or bullish? What are the previous supports and resistance? Does it like to bounce from bounce down from $100 and rally at $70? Or like what is the overall structure of it? So how long has it held this sort of structure? These are all context and are needed for these for a setup. While a signal is like the wicks. Like did price just reach the top part of a downward trend with a very so let's just draw this out. So say price was in a downtrend and it came up to here. When it reached this top part, did price kind of look something like this? If price looks something like this, where that means price went all the way up to its topward trend and then it scalped all the way down, this is a really good sign that we are probably going to continue this downward trend. This shows very strong seller resistance and short resistance. Or did price just close above a trend like how we saw before? Or a recent intraday high or low, which pretty much means any recent high or low, either that be yesterday, a week ago, 2 days ago, or a pre and post market high or low. Like did it break above that? Did it bounce off of that? These are all very important signals that it could be given. And or did, like how we saw on Nvidia, did price open below its trend and then start rising on good volume? Most of the time it does that. So you can be successful without the signal and just purely relied on the trend in support and resistance. Lots of traders do this and they make good money from it. You could buy a strong bear bar in a bull trend or sell a strong bull bar in a bear trend without any classic candlestick signals. What matters most is really what happened to the left. But signals can help. So here we have on AMD's weekly chart, where it was in a downtrend for over a year, making lower lows and lower highs. And if we grab its overall trend of this, we can see we have a 3 touch point. This is pretty much an A+ setup. And with also from the last time it touched its top part of the trend, it was following the 9 EMA down, where it was so just a quick rundown. I'll get more into this probably on what my setups are. The 9 EMA is just for shorter term overall trend, and the 21 is to give like possible dips on it. So since it was following the 9 EMA is like trading extremely heavily on a downward trend. So now, since that we know the context of it, it had a 3 touch point on the trend. It's been in a downtrend for over a year, and it's been following the 9 EMA down. Then the next time that you want to short it, the next time it hits its 9 EMA, which we can see if so price did go up to its 9 EMA almost over here, so then you could short it down. And that would have worked in the end because price opened all the way down here. Or the next time it hit the top part of its trend, it did that consistently for 3 different points. You could then short it at that point. But say if you would want to do the reverse and do the lower probability of waiting for a break on it, like if you want it to be long, you could wait for AMD to break or close above its 9 EMA, since it's been following that down for a while. Like this would not be a break. This is just price opening above its 9 EMA. You could wait for it to break that, or you can wait for it to break its upwards trend, where we can see the next point. This would be a break, because if you look at it, price finally closed above its 9 EMA. It has not done that since September 9th of this time, and it led to this huge run which led it back up to its trend. So then if we let this play out, price is started to rise excessively all the way back to its trend, where then this could be a point to sell or to wait to see if price will then close above its trend, finally breaking its year-long downward trend. And price closed above its trend here. So then you could actually double down in this scenario or average up, since now you know this is going to be an insanely good winning trade. Which then this break in its year-long downward trend led to this huge and insane move upwards. Absolutely insane. It did go even higher. Actually, hold on, let's just play this out entirely. Look at that insane jump up, already going past its past high. This is how fast these breaks can move, and these very small what seems like insignificant movement upwards can lead to these insanely high trades. And also notice on how you know it's now in a bull trend is when it started following the 9 EMA upwards, after it was following it down and it had a break here, which led to you pretty much either entering in on this signal here, we're at $98, and then possibly getting out at 127, a almost 30% increase on a really good company, or averaging up, and now from that average point you being back up almost 80% in about like less than 3 months. It is really great, and it's really cool what price action can do. It can make you a whole lot on just shares alone. So this looks very intense, but trading can make you rich, which is true, and this is essentially what my charts looked like when I started trading half a decade ago, when I filled my charts with like indicators such as these, like a whole bunch of these Gann fans, super trends, thousands of moving averages and RSIs, and it's just a lot of clutter. It's just filling my charts, cluttering my charts, and just with the hopes of me being able to predict the market and make me rich. And what happened from this, I either lost money or I never took a trade because I got what's called analysis paralysis. I always just kept on waiting for breaks, kept on waiting for retest, and then by the time I would get in, it would either just reverse because I waited too long. So then one day, I just decided to remove all of them. and look at the chart. This is the same chart, and then suddenly you can see it was in an upward trend, where then it had a break on it, where then it went down, uh, where then it made this triangle pattern with good support on the downside, decent support on the upside, and a small parallel channel where then it also broke below it, which could have also led to a short. You would wait for a break on this triangle thing. It broke to the upside. You can get out at there, only really having the 200 moving average on here, which gives you a broader, just gives you the broader trend. So this is on the 30 minutes, a 200 moving average. So it takes the last 200 candles of the 30 minute and finds the average of that. Whenever price crosses below or above these, it would normally signal a change in trend. And you can see that once it broke above this was a good area to then retest and then get into a long, and then you would have a gap up, where then this bottom trend later became a resistance. This happens a lot of times. A support as price keeps on moving up, and then when it goes below, it can normally turn into a resistance line. So this is where price would normally start to bounce off of it. It just becomes the chart becomes a lot more clear without all the clutter from a whole lot of indicators. And also, you don't have to use a 30-minute chart or a 5-minute chart like how we were using before. You can use any time frame that really you're looking for is the least amount of chop. Like how we saw with Nvidia, there was on the daily chart, there's a lot of gap ups and downs, and it was really hard to read it. So you just go one step higher to the weekly, and then now you can see that it was in more or less of a channel. And that's similarly to if you're on the 1 minute and there's a lot of chop, then you can go up to the 5 minute. If there's still a lot of chop on 5 minute, you can go up to the 15 minute, to 30, or 1 day, or to the weekly, to monthly. It's just overall shape and structure will remain the same. You might and also trends made on higher time frames tend to be way more stronger than ones made on lower time frames. So you might see a strong break, a bear or bull flag, a strong bear spike, a pullback, or a test of the recent low. All of these patterns exist all the way through each and every chart, no matter what time frame it is, no matter if it was 100 years ago, 80 years ago, 20 years ago, 20 years in the future. It would all be the same. These patterns are doing are just representations of price actions and statistics. So that pretty much concludes what is price action. In the next section, we'll go over on how institutions move the market, and with algorithmic trading, and on how pretty much it's just computers moving the market, and how you can actually use that to your advantage.